I'm Imam Hoque. As mentioned, I cover the EMEA and Asia Pacific region, and what I want to do is talk to you today about how to actually make the most out of analytics in your organisation. Because a lot of people worry about the actual analytical techniques, but they don't worry so much about the impact that those techniques actually have on the way your day-to-day operations work. We have the presentation on these. So, I've probably spent the last, I would say, 7 or 8 years working with multiple organisations, tax authorities, Swiss organised crime agencies, and even commercial organisations around the world trying to address these issues and challenges. So, first of all, what I want to do is just start off and talk a little bit about the data sources that you typically involve. It doesn't matter what domain you're working with, the more data you have available, the better. In the case of the tax world, typically you want to have your direct tax data, any sales tax, corporate tax information, VAT if you're worried about that problem available. But then you also want to look at other types of data as well. So you could be considering data like which directors work for which companies, which other adverse data sets do other government departments share with you? What about financial information such as offshore accounts? If this is an organised crime environment, then the sort of data you work with there would involve things like the individuals, people's flight information, police crime records, who owns what vehicle, and so on and so forth. So, it's worth probably pointing out that you can use analytics within a tax environment for many different problem sets. At the top here, we're talking about fraud and detection of fraud and evasion of tax. So the sorts of problems you can tackle if you take an enterprise approach are things like under-declaration to individuals and companies, VAT, carousel frauds, things like the taxes that you lose on contraband and smuggling into a country. So the duties on things like tobacco, and so on and so forth. And as you can see, there's a whole range from those sorts of direct tax issues to things like social insurances, healthcare, and even people trying to evade tax by putting their money offshore. But the enterprise analytics environment isn't limited only to fraud problems. You can use the same environment to make many optimizations within your organisation. So, segmenting your taxpayer is a really important thing. How do you contact your taxpayer? Is it via meetings or inspections? Is it via letters? Is it via emails, calls? What techniques should you use and what will deliver the best results for you? So this could be addressing problems such as debt collection optimization, how you do the inspections, so on and so forth. So there's a whole range of optimizations you can make. So, what I want to talk about now is people know about data and analytics and those underlying techniques, but they also know about the business processes. The bit that is often the hardest bit to get right is the connection between the data and the analytics and the teams who are doing the modelling and then the actual business operations that you may be running. So here, what we see at the bottom is our data environment. We're ingesting lots of data, we're producing a warehouse, and then we're running analytics against that environment. At the top are our operations and processes. The first technique we use in our business processes is scoring. So you may have events that are occurring, such as somebody's requested a repayment of tax. You want to score at that point in time, is that a good repayment to make, or could you be dealing with a fraudster? Equally, you may have tax returns coming in, or there may be changes within your environment, and you may have an annual cycle where you basically reprocess all of your taxpayers to work out where there may be risk of under-declaration, fraud, and so on and so forth. Of course, if you have a scoring environment, you then have to deal with the alerts that it creates. So the environment runs across the data and it generates alerts. So then you need an environment to deal with those. So this is your environment for managing these alerts, doing investigations, and deciding what the outcome should be. Now, unfortunately, in some cases, the situation looks pretty bad and people are stealing lots of money. So there are many tax scams and fraud frauds that are happening where single gangs of people may be taking tens of millions of pounds, euros, or dollars from the tax authority. And in those cases, you go into a special investigation mode, and that's more like an intelligence operation. And then finally, what you do need to do is you need to monitor how well this environment is working, because those models, rules, and techniques that you're using to generate the scores and the alerts and detect the potential frauds, they need to be updated all the time. The fraudsters change their behaviour, so you have to analyse and report on how well your hit rates are going, and then decide what you're going to do and whether you're going to update those models. So that's an overall typical set of concept of operations to run an analytics-driven environment to produce a real outcome. So how do you actually make this effective in the real life? The first thing there you see in the middle are what I call models. So these are the actual analyst models that, so the models in the middle are the pieces of basically the creations of the individuals of the analytics. But you need to choose which big business problems should you address with analytics. Not every business problem is the best problem to address with analytics, particularly if you're starting out. If you're starting out down this path, you want to have an impact. So you need to choose the right business problems that are best solved, where you're going to have the best impact. Because if you really want the users to adopt the system, you need to produce good results. The next thing is the data. You need to spend a lot of time working out what data is available and what data could add to your detection. An example here, for instance, I saw was people trying to detect the hidden economy. So they were looking for businesses that were never even registering to pay tax. So people were running entire businesses and never even registered. Now, how does a tax authority know that? Well, one thing you can do is you can take things like business directories and find businesses advertising and then cross-check those against who's actually submitting tax returns. And you may find that there are many businesses that are operating in the hidden economy. The tools and techniques are very important, and I'm going to talk a bit more about the tools and techniques in a while. You've got to use the most advanced capability to produce the best output from your detection models. And then finally, there's the working model. I often find I go into an organisation and all the analysts work in their own unit. It can be a bit of an ivory tower, and they don't interact regularly with the rest of the business. For analysts to really work well, they need to have a committee they work with super users and investigators, so that they can have a day-to-day dialogue or regular dialogue, say, how are the models working? Is this what you're expecting? How should I improve this? So that's also a very important fact. Once you've got your models, though, you then need to basically operationalise them. Models alone don't produce any outcome, so you need to connect them to the real business. And that's where the rubber hits the road. You make the real difference in your day-to-day operation. And then finally, the most important bit of the equation is adoption. If the users don't really adopt what you're producing and they don't think it adds value, then all of this has not really been a successful process. So adoption is something I'm going to talk about. How do you get users to really adopt the analytical models that you produce? So there's one theme that's in common. It doesn't matter whether you're doing insurance fraud, banking fraud, tax fraud, or whatever it is. All organisations seek to measure themselves on these metrics, and this is what you should set up as your set of measures to see how well you're performing. So firstly is, how much of a fraud are you detecting? Are you getting enough cases? Are you finding the really large-scale cases? And are you discovering new types of fraud? Once you're confident that you're getting enough fraud, of course, one of the big issues are you're generating too many false positives. So you get alerts, you investigate it, it turns out it wasn't fraud. So in your attempt to cast your net wider to catch more fraud, you can generate false positives. So it's key to have a good model that then reduces the false positives and produces accurate results. Every time you do an inspection and you get a positive outcome, that's saved you time, but it's also had a deterrent effect on anyone who knows that organisation that you inspected, because you know you had a good outcome. And then there's efficiency, and this is the third major metric. So when you're basically processing all of these requests and alerts, the faster you can make your investigation teams, the more volume of work they can go through, and therefore the more inspections, the more fraud they can find. So if you affect those three factors, how much fraud are you discovering, at what false positive rate, and how efficient are your investigators. They're the metrics that underpin any business that's about non-compliance or fraud detection. Obviously, total cost of ownership becomes an important factor too. Now, a key observation of many authorities around the world is that the problem is continuously changing. So quite often people say, well, why don't you just buy a solution, put it in, and that solve my problem? Well, it won't, because you need to develop the underlying capability in the analytics teams within your organisations, because tomorrow the fraud will be different and you'll need to change the way you operate. So you absolutely need to move to a world where you're self-sufficient and you're relying on tools and techniques where you can readily get staff, get them trained, and know how to use those products. So if we look at a couple of sort of scenarios, a case study. So I'm looking here now at the numbers for the UK Tax Authority, Her Majesty's Revenue and Customs. And if you look at the breakdown of their tax gap, they reckon they lose about £32 billion a year of tax. It's quite a sizable number. A lot of it is just errors, people fill in their forms incorrectly, or they're not taking reasonable care, they're not doing anything on purpose. And in those cases, you want a customer contact strategy. Maybe it's an outbound email or letter suggesting a different way to fill in their form, or they might need some assistance, or they should go to the site for further information. Some people just don't pay their debts, and then it's all about how do you optimise your debt collection. And there's lots of ways in which you can improve that as well. Now, a lot of the people are actually avoiding tax, so they don't see themselves as hardened criminals. They're just thinking, well, I'll just put some numbers down and I'll avoid paying a bit of tax. And that's really about your customer contact strategy. Typically with those people, if you can produce an automated, personalised letter that outlines what it is that they're doing wrong and send it to them, they then realise, somebody knows what I'm up to, I need to now declare properly. But if you look there, the largest number, 46%, is actually people who are attempting to avoid paying tax, or it's in the hidden colony. And here you've got to do automated detection and then inspection. Even if you inspect most cases, you still have to work out which ones do you spend more or less time on. Can you actually spot where someone's being fraudulent? So, in the case of the UK, the tax gap is made up of a whole range of things, and I just put some examples up here. So, one example is bonuses as expenses. One of the most favourite cases in the UK is partners who work in big consulting firms. They earn a lot of money, but they avoid paying their tax, and they think they're very smart. And it was a great event in the UK Tax Authority when we managed to discover about 30 partners working for these large accounting firms who were avoiding tax. And they were basically creating second companies, which are limited liability partnerships, and they were putting their bonuses there and draining them out of expenses. But we were able to detect that by using analytical techniques across their data. Other typical examples are undeclared properties. People own multiple properties, they rent them out, and they don't declare the tax. So it's just some examples. So what are the top tax authorities around the world doing to address this? Well, they're basically putting in a data-driven approach to the way in which they do their tax inspections and their detections. So they take their data sources, they aggregate that data through a data integration process, and they produce an underlying data warehouse. Now, what's quite important about this is they produce a view around individuals, a view around small businesses, and a view around corporates. And they produce a single view of that data, and they link the data up. So it's quite important what you do with that underlying repository before you even start thinking about applying analytics. Then they apply a set of what we call hybrid analytics, and I'll talk about that in a moment. And they generate their prioritised alerts, which are then worked through case management, and they go through their reporting cycles. So, data preparation is critical. Even if you don't have great data quality, there's a huge amount you can do today. So you start off by ingesting your data, applying quality metrics to it, and improving it. If you've got unstructured data, so text fields, descriptions that people may provide, you can mine this data as well, and you can find some real nuggets in there. What we tended to find were things like expressions that people put in their tax return that their tax accountant had recommended to avoid tax. And we could see these expressions cropping up, and that was a way of risk rating whether somebody is likely to avoid tax in their tax return. So text mining is important. That data, once you've got it, you then have to produce a single view. And a single view is not as simple as you might think. A single view of a business is actually very complicated. Businesses have hierarchies, subsidiaries, multiple directors involved, employees, and so on and so forth. Then you link the data. So linking data is quite critical. So we heard earlier on about a discussion about people using variations of addresses or giving the address at a different time. If lots of people are using a subset of addresses, you want to know that. You want to know they're linked together. If companies are transacting with each other, you want to know how they're transacting. So if you link your data exhaustively, it produces a large network of all the relationships. Now the problem with that large network is it's not very good for analytics or storing. So you then have to get the system to break it up into islands of interactive activity or communities and networks. A household is an example of a community and network, or a family grouping. Because sometimes when you're paying benefits, it's at a family level that you're operating, or a small business as a community. Once you've got those, then you can basically look at how that community moves and operates over time and what its metrics look like. So, once you've got your data, it's then about the modelling. So we use what's called a hybrid model. A lot of people say rules are old school, but rules are still really good. In fact, rules are very powerful because if you sit down with the best tax inspectors, for example, or your best intelligence agents, and you say, what do you look for in the data? What they tell you, you can then code as a rule. So it is a very good way of effectively amplifying your best people across the entirety of the data. An example of a rule might be, show me every single tax return where it would appear that the person has got multiple property ownership but there's no declaration of rental income. That's not to mean to say they're fraudulent, they may just own lots of properties and not make them out. But in actual fact, that's a pretty high-risk situation. Anomaly detection. This is a really important technique, so this is about outliers. Why is this textile firm, which is a similar size to many others, has a similar number of employees, claiming such a large difference in the volume of sales that it's making? Is there something wrong here? Are they under-declaring? They're an outlier. Predictive modelling is very important as well, so there's all sorts of techniques. We can look at time trends of how businesses are changing and predict what they should be doing in terms of the sales revenue, or we can look at bandings or age groups which are higher risk than others, and so on and so forth. Text mining, as I mentioned before, your underlying text contains a lot of useful information for risk scoring. And then database fuzzy matching. A really obvious thing to do or to look for in your data is when you know you've had people who have been fraudulent about their tax return, why not just match those directors into the new companies that they may have opened and are trading again and see whether those match up? Because it's an obvious thing that if a director's previously been fraudulent, there's a higher risk that he'll be fraudulent again. And then finally, we've got network analytics. This is the ability to link things together to say that we would suspect that this current accounting firm is helping organisations to avoid tax. Who's linked to that accounting firm? And what do their tax returns look like? So there are lots of techniques here. The key is if you're going to do a large analytics project in any organisation, preparing the data, integrating the system, testing it, connecting it to your business processes is a very large and expensive exercise, potentially in the long run. So if you're going to go to the effort, you may as well get the best and most accurate possible model that will give you the largest return on investment. So here's an example of detecting bank carousel fraud. There's basically a list of companies, and the inspector can look down the list, you can see the risk rating, and you can see a set of reasons why you should inspect those particular companies. Now, when you're building scores, it's quite important to think of scores at three levels. There's an event. An event may be a request for a repayment. So you can score that request for repayment in its own right. For instance, you can look at the value, the amount, how it compares to the how it's been requested, and information just about that event. Then there's the entity. Well, you can look at the individual from whom it's coming from. What's their history? What have they done in the past? What's normal for them or what's not normal for them? So you then need to have a second layer of model which looks at individuals and entities, businesses, people, so on and so forth. And then the third element is the network element. So if someone's requested a repayment, what's the bank account that's going into? Have we got any other evidence of any other payments being connected to the same bank account? For instance, it might be strange to see 50 repayment requests all going to one common bank account. So once you score on those three levels, it gives you much more accuracy in your model because you're combining that set of scores. Now, when you present the score to the end user, it's very important that you don't do what's on the left. So what's on the left is risk score is 65%. So as an investigator, what do you do with that? Okay, 65% of under declaration, not very useful. If, however, your system presents scores as they are on the right, breaks it down by individual, event, and network, and it says something like, the income is inconsistent with the property postcode. Somebody seems to earn too little for where they claim they're living. It's not progressing over time with inflation. There's a land registry that indicates this person's got 4 properties. And there's no rental income declared, and they're connected to an accountant who's got suspicious previous activity. When you combine those factors together and present that score to an investigator, then straight away they know where to start looking. So what you need to do is you need to have a system that pulls together all the evidence. So on this particular screen here, what you see on the left is some information about the individual who's been found up. On the right, there's some graphs that are generated to show what his benefits claimants are compared to his peer group, how things have changed over time. And then at the bottom are all the rules that triggered and all the models that triggered to suggest why you might want to inspect this person and why he may be fraudulent. So that's a real help if you present the investigator with a case pack that has that information. And then the next piece of the equation is something like this. So on this diagram, these diagrams can be generated for every single tax inspection that you may want to do, or any organisation within your tax environment. So on that diagram, it's showing an individual at the centre who's got 4 properties, and he hasn't declared any rental income on his tax return. He's linked to an accountant, and around the edge there, that accountant has had 3 or 4 other tax returns that they've been involved with, which have shown up to have fraudulent behaviour. So straight away, when I'm an inspector and I see that, I can start understanding how I'm going to tackle that individual, what I'm going to do when I contact them. So I've talked about a number of different techniques. This new technique, which the statisticians amongst you may have heard about, may not have used it yet, which we call social network analytics, which is connecting the data up and then risk scoring networks rather than just individuals, is a very powerful technique. If you were inspecting tax returns and you took a random sample, you would expect if you sampled 50% of all of the tax claims, you'd find 50% of fraud. If you deployed a set of rules, quite often that will improve that. So I could then sample 30% and still find 50% of fraud. Sometimes, however, rules become a problem because when the bad guys know what your rules are, they can become worse than random because they specifically avoid what you're putting in the rules, and then you'd be better off going back to a random set. If you deploy a predictive model, things get an awful lot better, so you're now throwing more techniques. So now you can probably sample 25% of all of your tax returns and still find 50% of all fraud. If you include S&A as a technique, the yield goes up even further. So now, if you inspect 25% or so of all your returns, or even as low as 20%, the ones that are being alerted by the system, you'll actually discover 75% or more of all the fraud. So, using these new techniques, you can make a very significant difference about how you're detecting fraud or any other problem, organised criminality, whatever it may be. So I often get asked, how do you actually measure the entire amount of fraud within a tax authority, or how do you measure the tax gap? So this is the approach that we normally take. At the top, there's what you know you know. In other words, these are the frauds we've caught and we know about them. So you can measure those immediately, and normally you treat those by going to some sort of debt collection exercise. Then there's the what you know you don't know. So I know I had this set of frauds. It might have been a rental under declaration. I know I only sampled 25%, so I probably know that I'm missing 75% of other frauds which look like the ones I've already seen. And that's the what you know you don't know space. And what you do there is you basically can project from your sample size or from how you do your inspections to understand where you may be missing fraud. And you create rules and you scan your data. Then there's the big problem space, is what you don't know. So there may be a type of fraud that's hitting you that you don't even realise, you've never come across one, you haven't spotted it. And there you really can't quantify the size of the problem. I'll give you an example. In the UK, you can fill in your tax return online. What happened one year was all of a sudden a large percentage of the population were filling in their tax return really, really promptly online. And the tax authority thought, this is great, everyone's filling their tax return in on time. This is such a different change. Until they then noticed a few months later that people would ring up and say, I tried to fill in my tax return, it looks like I've already completed it. And what had happened were gangs from Eastern Europe were stealing identities online, going online, completing someone's tax return and claiming a tax rebate and changing the bank account details where the rebate's going to go. The tax authority processed it and sent the rebates out. So as this progressed, they suddenly realised that they'd been hit by a completely new type of fraud they'd never seen before. And it took them quite a while to deal with it, to work out how to cope with it, but the losses were very, very significant, into the hundreds of millions of pounds of losses. So how do you find out what you don't know? Well, you're looking for the unusual. This is where you do outlier analysis, where you're trying to find things that you haven't seen before and then explore the data. So use some of the techniques that Deepak was showing you with visual analytics. Drill into that data. Ask yourself, why is there a spike? Why is something different? So you need a team of people who are always looking for this new and emerging fraud. And that, once you've got that, once you know there's these new types, you can then say, fine, I'll write a set of models or rules, I'll scan my data, I'll produce a set of alerts, and we can investigate a sample of them, and then you can measure what you think that what you don't know is. So, it sounds quite simple, but actually it's a complex process for creating models in any environment, whether it's tax or whatever it is, because it depends what you're trying to do or achieve. So here, this is the sort of waterfall approach that you would use. So first of all, you've got to find out all of those individuals who are potentially being fraudulent or avoiding to pay their tax. Once you've found them, then you need to segment them. How are we going to treat them? Are we going to send them a letter? Are you going to ring them from the call centre? Or are we going to do an inspection? And that's really about managing the cost and effectiveness. And again, you can use an analytical model to do that. Then you've got to ask yourself, which ones will actually give us yield? No point inspecting someone you think you can easily get to, it's definitely a fraudster, if they're only going to give you a time amount of money. So then you do a prioritisation based on yield, which is about propensity to be able to recover the money, and then also the fiscal value. And then finally, you can further subdivide your set, worrying about how will it have an impact on those around that individual or that company that I'm inspecting. So basically the deterrent impact is about making good inspections that have a great outcome. If you make an inspection that doesn't have a good outcome, or you miss some fraud, then someone will tell all their friends, hey, you know, they inspected me and they never found anything, this is what you do. So you need to think through this very carefully. There are lots of different types of problem spaces. So debt collection optimization is another example where you can segment the market and you can choose how you address the different individuals. So if you really want to get people to adopt your analytics, there's a lot of things you need to think about. So you need to involve the end users and the investigators. That's really important. It's a journey. Start simple. Don't try and do the most complicated model from day one. Avoid a black box. Don't just present people with percentage likelihoods. and then focus on getting results. Try and choose the areas where you know you'll get a good result straight off, then everyone will get excited and then they'll say, right, can you come and do that in my department as well? So it's quite important for adoption. And enable the end users, make sure they've got the tools to do what they need to do. Give them the data, present it to them. And then finally, just keep piloting and iterating. So when you do this, one of the things we did find amongst many tax authorities is collecting all this data together and producing this case package is really powerful. Because if you ring someone up who's not paying their tax, and you can actually explain to them over the phone why you think they're not paying their tax, they usually say, oh, I didn't realise, fine, I'll pay it. Because no one wants to get into a big debate. So on this diagram here, it's about how can you use your data to get a result quicker or to determine that they're really not a fraudster, so you don't spend too much time. And then finally, if you're going to set up your organisation to succeed, you need to think about all of these factors on your program. How good is your analytics team? What collection scenarios are you going to target first? Which business problems are you going to go for? What data sources are you going to use and what data quality? So you need a program to work about that. What functionality are you going to put on the desktop of investigators? This is really critical. And then how are you going to segment your customer base and how are you going to address them? Are you going to write letters, send emails, or contact? And then finally, how are you going to automate this system? You don't have to build the most complex IT system from day one. You can do lots of piloting. And then finally, think about your organisational structure. You need a structure who's willing to accept analytics. And if you can do all of those things, and you have a program of work for those, you can really make analytics successful in your organisation. To the tune of, for most tax authorities we're working with, we'll probably save them billions of euros or dollars per annum. So it's a very large piece of business trouble. Okay, that's all I wanted to say. Are we going to move straight on or questions?